Hi everyone, this is Doug Brennicke. In this installment, let's talk a little bit about self-employment. Self-employment is different for an underwriter than it is for analyzing somebody who has a job. The underwriter always wants to be able to verify the stability of the employment and the stability of the income when they're dealing with their loan approval. For a person who's a wage earner or salaried, it becomes a much easier process because we usually have W-2 forms, we have pay stubs, we have an employer with an HR or a payroll department where we can get questions answered as to whether that person looks like they're going to be continuing employment and what the likelihood and prospects look like for them. For a self-employed person, however, since they're their own boss, we don't have an HR department or a payroll department to deal with that would give us any kind of independent information. It's going to be coming from the owner of the company, and that typically isn't going to be acceptable as far as an independent verification. So what happens for a self-employed borrower is that we tend to use the tax returns for the last 2 years as forming some kind of basis for establishing their stability of employment and their stability of income. A minimum standard typically is that a person does need to be in business for a minimum of 2 years before we can even start to understand maybe what their income stability looks like. If they're in business for less than 2 years, it's unlikely that in today's lending environment that they would even be considered for having any of that income contribute to their qualifications because the business is just too new. Many people go and spend a lot of money at the very beginning and show losses in their first couple of years, and many times people do go out of business very quickly. They find out it's a little bit tougher than they anticipated in order to be able to get their business running and have it be profitable. So 2 years of tax returns is the basis. And the lender is going to be taking a look at the net business income, not the gross. So if you have a company that brings in $250,000 a year, but it costs you $200,000 in the form of buying materials or hiring employees or leasing space or outsourcing different things with contractual services, maybe you only net $50,000 from the running of your business. That $50,000 figure is going to be the one the underwriter looks at, because in a sense it puts you at an even basis as a self-employed person as the salaried worker. $50,000 net business income is pretty much the same as your gross personal income, which is the number that the underwriter uses for a wage earner or salaried person. The tax returns are going to be critical. It's difficult for an underwriter to accept anything other than what's on those tax returns. The reason for that is that if a borrower is willing to represent to the government that these are true and correct numbers, that all of these deductions are valid, and that this is what it costs them to run their business, it's going to be difficult for an underwriter to accept any other explanation than those are the true and correct numbers. Many times we'll hear a borrower say, well, I was pretty aggressive on my deductions for tax reasons so they could minimize their tax liability. The underwriter is going to still take those numbers and say they must be real because you are going to be in a position of possibly defending them to the IRS. So tax returns are the basis for being able to ascertain the stability of that income. Many times they'll use an average for a couple of years so that they can take out peaks and valleys on the income calculation. So I hope that gives you a little bit more insight for a self-employed borrower and how they're treated in comparison to a wage and salary earner. And we'll move on to another lesson shortly. Thank you.